Consensus is pretty constructive. It's pretty bullish, as it should be after, I mean, most stock indices in the U.S. are sitting near all-time highs. And so I think people are very constructive. Unfortunately, when you get into that mode, you stop thinking about what could possibly go wrong.
Right.
And I think that's the most important question to ask when you're bullish. And the answer this year, I think, is inflation.
And linked into interest rates, Urian Timmer out on LinkedIn with a brilliant chart migrating the 5% 30-year bond a higher yield. Link out of consensus in the equity market with a 5.2, 5.4, 5 point whatever percent 30-year.
I haven't seen it.
Well, I know you haven't seen a chart,
Yeah.
but the basic idea is higher inflation, higher yields, marketed to 30-year bond. How will that affect the equity markets?
Push out the curve. Well, that's the issue. Is I think people are really focused on one thing when it comes to inflation, and it's oil, which is now off the boil. It's really when a rise in commodity prices, energy prices, turns into core inflation, or what the Fed calls underlying inflation, that it becomes an issue for market multiples. And I'm fearful that might be what we're wrestling with come the fall.
We have a new Fed chairman, Mr. Warsh. Presumably he comes in with some kind of expectation to lower rates, if you will. But boy, the data doesn't seem to support it. And what do you expect to hear from our Fed?
It's in a tough spot.
Yeah.
Let's be honest, because the data is very constructive. Particularly if you look at the PMIs, the ISM yesterday,
Yep.
the regional PMIs are seeing these smile patterns in virtually every data series. I think that was a surprise to consensus, after what occurred in March. At the end of the day, we have an insane amount of stimulus hitting the economy in 2026. So it is your classic recovery, the tide that lifts all boats in earnings. We're clearly seeing that, and it's being augmented by what is happening to AI. Forward earnings growth for the S&P is up 29%. I've been at this a little over 30 years now. I've only seen numbers like that twice, coming out of the GFC and coming out of the pandemic. And so this is really unique times that we're in, but that is often a sign of an economy that is overheating.
How about you see, like Tom mentioned earlier, Google coming to market really the first time since it went public 20 some odd years ago, with this massive equity deal on the backs of the tech industry for the first time really in its history, tapping the bond market in size. What do you make of all this investment in AI? It's something like we haven't seen, really.
You were asking me about consensus. So one place where I think it might be off is just how strong the U.S. economy is in 2026. A lot of people are still hung up on structural issues, and they're very legitimate. But cyclically speaking, if you do back of the envelope math, you're getting about 1% to GDP growth this year from the Big Beautiful Bill. You're getting over 1% from the CapEx cycle, from the top 5 hyperscalers, which is a little mind-blowing if you think about it. And then we haven't even talked about the lagged effects of the Fed's rate cuts, which take almost 2 years to impact the economy. So it's not that difficult to get to 3-4%, in 2026.
The nominal GDP is 5-ish, or dare I say, with inflation 6%. Well, I guess it's not a banana republic. But it's not the American economy we knew 2 years ago, 12 years ago, 22 years ago. It's original, isn't it?
Well, what's changed is fiscal stimulus and monetary stimulus. I would say we had the CapEx cycle. It wasn't as pronounced as it is today, but we've added to that rate cuts, and we've added fiscal stimulus.
Okay, so inside baseball, folks, I don't want to nerd out here. It's too early in the morning, and Alexis and I were up all night talking about the Knicks. The bottom line is the Kalecki-Levy theory, which Richard Sharma talks about in the FT, is that if you have a big government deficit, some of that rolls over as a spirit into the private economy. It's a theory 50, 60, 70 years old. Are we getting a goose to our economy because of all this debt and deficit?
Partially, yeah, absolutely. And I think the real challenge for Warsh is that the Fed is dealing with labor markets that are unlike anything we've seen before. We have literally zero growth in the labor force this year, partially because of demographics, partially because of immigration policy, but we haven't seen anything like that.